market movers. This is The Pulse with Francine Lacqua.
So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Trump administration has diffused some of the tensions that had rattled financial markets, walking back comments on both the Fed and China. Now, President Trump says he has no intention of firing the Federal Reserve Chair, Jay Powell. And on trade, the U.S. president also floated cutting tariffs on China substantially.
We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
Well, we'll discuss what all of that means for the markets with Mohit Mittal. Pimco is the Chief Investment Officer for Core Strategies. Also joining us, Ross Matheson, Bloomberg's EMEA News Director. So thank you both for joining us. Ross, first of all, let's get caught up in what happened over the last 24 hours. So first it was Scott Bessent and saying, look, everything will be fine with China. And then President Trump was pretty forthright. I don't know whether he's looking at the markets or he just wants things to ease down a bit.
Well, it's an indication maybe that at least tariffs won't go higher in the near term. But for tariffs to come down, we're really needing to have a proper sit-down conversation, and those talks have to happen. And there's no sense of when those talks might happen or who might be involved. Particularly what you really need is Donald Trump and Xi Jinping, the president of China, to talk directly. So an indication at least that he doesn't want to keep pushing things in this tit-for-tat gambit at the moment. But it doesn't mean that tariffs are going to drop significantly and immediately. And it does also require China to say, well, we'll agree to do this if you do that. So there has to be that negotiation. And the commentary from China overnight has been interesting. They indicating again in their foreign ministry briefing today they're very willing to have conversations with the US, but also Xi Jinping saying in comments overnight that, trade wars benefit nobody. He's not really shifting heavily on the rhetoric, especially when it comes to the US. And so you can see that China's been very willing to play hardball with the US on this, and their economy arguably is a bit better insulated against some of this trade behaviour that's happening. And so there has to be an impetus for China also, and China doesn't like to give concessions. So we're not necessarily in the realm of a full pullback at this point, but opening the door, perhaps if we can get towards talks, maybe we can get to some kind of understanding.
I mean, markets were very quick to react, right? And they're definitely taking some relief on the comments on both Jay Powell but China tariffs. Has a dramatic shift out of U.S. assets been overblown?
Yeah, I think markets have certainly reacted a fair bit to the news of the last few weeks. I think from our point of view, what we think of it is take a step back and look at what the situation is overall telling you. And when we think about it in that sense, what we observe is that even before April 2nd, we were starting to see the weakness in the data in the U.S. Sentiment data was weaker, but so was a little bit of the hard data like the credit card data, retail sales data, or the travel data. Since then, the uncertainty has increased quite meaningfully. So what that means is that the consumers, as well as the corporates, will be a lot more cautious in terms of thinking about spending and investments. Normally, in such an environment, you expect yields to go lower, treasuries to rally. What we have seen is actually yields move higher in the last 3 weeks. So why did that happen? One narrative, as you mentioned, is basically the idea around foreigners reducing allocation to U.S. assets. I think certainly some of that is likely happening as the uncertainty around the U.S. is creating that anxiety in the minds of the foreigners. But then also is a big global delevering that is happening because the volatility increased so much that it created VAR shock in many of the levered strategies. So as that happened, rates moved higher. But in the context of the longer-term fundamentals, which I mentioned, kind of economy slowing down, growth weakening, if you think about it in the next 6 month to 1 year horizon, chances are growth will be lower than what it is today, near 0%. And in that sense, rates look quite attractive. Treasuries start to look quite attractive in the 5 to 10 year point.
But, I mean, given all the volatility, is today an opportunity to re-risk portfolios on a possible trade deal? Or is it too soon?
I think there will be volatility, there will be a noise, and that volatility will create, kind of more moves in both the rate markets, credit markets, and equity markets. So the question is, where is the opportunity? From our point of view, when we look at kind of where the opportunity is, the rates market stands out. In the US, in UK, in Australia, The Treasury, the gilt, and the Australian government bond market stand out, where basically the market is not fully pricing in the growth weakness that this scenario is creating. Market is assigning reasonable probability or high probability to the scenario that, for example, for the U.S., foreigners might reduce allocation to U.S. holdings, but not assigning as much probability to a scenario that growth will weaken, thereby that opportunity in the rates markets. I think on the credit and on the equity market, we still have to be a little bit kind of cautious. There will be more volatility, and we have to recognize that this environment creates a scenario where growth prospects are much weaker, which may not be as strong an environment for credit or for equity markets.
But we also spoke to Venkat, the chief executive of Barclays, yesterday, and these were his thoughts on the U.S. as a reserve currency.
It's 100 years, 80 years, 100 years of dollar strength, so much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
But given the uncertainty and unpredictability of the policy agenda of the Trump administration, how much premium do you think investors should be attributing to U.S. assets?
Yeah, so I think firstly I agree. I think the dollar will remain the reserve currency. I think a big portion of the trade happens in that, and there's not a clear alternative to what that is, to what a reserve currency alternative to U.S. would be. So dollar stays as the reserve currency. Now the question around how much premium that investors will ask, I think we have seen a meaningful increase in that premium already getting priced in, particularly in the rates market. Even the dollar now, at least as of yesterday, had moved to levels 3 years ago. So there is already a meaningful premium that has been assigned to that. Certainly that can move a little bit more. More premium can be assigned. But I think for many investors like ourselves, it's also starting to create opportunities, particularly on the rate side, to take the other side of this premium that is being built in because of the growth backdrop. On the dollar side, I think usually when currencies kind of move, it tends to be a little bit more longer-term trend. So there can be additional weakness in the dollar over the long term, but we also recognize that it has become a little more of a consensus trade in the market in the last few weeks. So any kind of headlines has the potential to cause a little bit of a snapback rally in the dollar as well.
Okay, thank you, Mohit. I want to ask you about the Fed in a second as well, but then the other news overnight was Elon Musk taking a bit of a backstep from the White House. Is this on concerns? Do we know what happened between him and the president, or does he actually feel that his job is almost over?
Well, he's coming up on the 130-day limit for his position as a non-official government employee, where he was going to have to probably step aside. There'd been a lot of talk already that May would be the end of it for him and he'd start to pull back, and particularly, again, giving impetus from the Tesla numbers that we saw last night. The need to get back to his business and pay attention to it is very real. I mean, they've got new models coming up. They've got the robo-taxi stuff. He needs to really get in there and pay attention to his company. But the timeline does match up with what we were really expecting for him to pull back. And what he's doing is he's got his lieutenants in place. I mean, Doge won't just stop dead because he steps aside. That effort will continue. As we've reported, there are other significant figures in the US administration, government officials, who've been architects of this policy. Also, the idea of really cutting back the US government in all the agencies, including the Pentagon, as we're seeing now, the State Department under Marco Rubio as well. So this is not a policy that's going to go away just because Elon Musk is no longer there front and centre. It may become less visible, and it may become more orderly, one could argue, but it's not going to stop. But it really is a sign, obviously, that Elon Musk is saying, I need to get back and pay attention to my business. There's possibly also a bit of a rift, as we know, between Elon Musk and Donald Trump over tariffs. And Elon Musk arguing that tariffs are obviously not good for his business.
Rosanne, I also want to ask you about the Fed. Now, President Trump has pulled a major about-face when it comes to his stance on the Fed. Trump now saying he's not getting rid of Jay Powell, despite criticizing the Fed chair in a series of public comments.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No. It's not, but it would be good timing. She could have taken place earlier. But no, I have no intention to fire him.
Ross, we were talking about, uncertainty and unpredictability, a word that I apparently can't say, in terms of policy. But the concern is that actually markets have to take him at face value, but then he walks back comments.
Well, that's right. I mean, he was using language around Jerome Powell that's more than you'd see kids in the kindergarten. I mean, calling him a loser, calling him incompetent, talking about, the sooner he's terminated, the better, and then suddenly saying, no, I'm not trying to fire him. And that relationship is fundamentally, if you call it a relationship, is fundamentally broken no matter what. Donald Trump is still going to keep talking publicly about where he wants interest rates to be and lambasting Powell if they're not where he sees them going. Perhaps three factors here very quickly. One is that obviously he's watching the market and he knows that really digging in to try and get rid of Jerome Powell would cause a massive roiling of the market, including the bond market, which is the one he seems to be watching. He could figure it's just too much of a hassle to try and do it. I mean, it's not very easy for him to do this. It's complicated and arguably he doesn't have the legal ability to do so. Jerome Powell's term, I think, is up in about a year, so maybe he figures he can just wait it out. And thirdly, Jerome Powell's quite useful in a way, because if the economy doesn't go where Donald Trump wants it to go, you've got a fall guy.
Yeah, I mean, the concern, again, for markets is that there was, pricing in the markets of somewhat of a risk, but actually they didn't really price it fully, because if the Fed chair was fired, it's all bets are off. So how do you deal with this, again, uncertainty?
Yeah, I think you're absolutely right. I think, in general, any kind of intervention towards Fed's independence is not something that the markets appreciate. Markets like certainty. This adds to an uncertain environment that has been created because of the tariff policies. So in a scenario where the intervention continues, that would be negatively viewed by risk assets across equities, across rates markets, across currency. It will certainly increase the risk premium even further than what it has happened.
You were mentioning, the behavior of U.S. Treasuries that were trading a bit like risky assets. Do you think their status is in question?
I think it has performed that way in the last few weeks. But if we look at the longer term, so if we look at, for example, what happened from January to March, when equity markets declined pretty significantly, Treasuries rallied. Similarly, if you look at the August 2024 period, when we had the big Japan carry unwind, equities declined significantly, rates rallied. You go back to 2023, the Silicon Valley Bank situation, equities declined, fixed income rallied quite significantly. So this last 3-week period is a little bit unique in the last couple of years. As we talked about, there are two reasons. One is around foreign reduction. Second is around a levered position unwind. For patient investors like ourselves, it has created opportunities to add exposure. So that's how we would think about it.
But Pimco still prefers bonds outside the U.S., right?
We like the U.S. exposure, but we also like U.K. as well as Australia exposures, as I was mentioning.
What else are we looking for, Roz? I mean, there's so much, again, uncertainty, domestically also with what's happening with the defense secretary, and it's things that the market's not pricing. Do we know how Donald Trump measures success? Does he want to keep, Mohit happy with the bond market, but then gets on with actually delivering on what he was voted on?
Well, he clearly wants to get some trade deals done, and a lot of focus this week, obviously, on India with the Vice President, J.D. Vance there, and very, very warm words for Narendra Modi, the Prime Minister of India. So he does clearly want to get some individual runs on the board, but he wants to do that on a bilateral basis. He does not want to be negotiating with countries as a bloc, which is why also the EU could be problematic for him. So he wants to demonstrate to the American people that he's delivering on some of this. He's slapped tariffs on everything, but now he wants deals. And that's very clear. Those deals may take months, but he wants to show at least progress towards them, including potentially with the UK, with Rachel Reeves in the US. So that's one demonstrable, obviously, he wants to show. And then physically demonstrating how much he's cutting government, that's another one. And Ukraine, well, getting a deal there, obviously, number 3.
And Mohit, when it comes to liquidity and market functioning, I know there were a couple of concerns over a couple of days. Do you worry about that actively?
I think it's certainly a focus for us. We look at it quite actively. But for now, when we look at over the last 4-week data, 3-week data, market functioning has been normal. There has been a little bit widening in bid offer, as you would expect. As volatility picks up, you see that in the Treasury market, you see that in the credit markets as well. But broadly, in aggregate, the market functioning has been normal. And I think a lot of policymakers look at that as well. And they get comfort that certainly there has been more risk transmission. across the public markets, which is kind of also important that public markets are able to do that risk transmission, even if a little bit of a bid-offer increase can happen during periods of volatility.
Mohit, thank you so much. It's so great to have you in London. Mohit Mittal there, Pimco's Chief Investment Officer for Core Strategies, and our very own Rosalind Matheson, Bloomberg's EMEA News Director. Now, coming up, we'll discuss the outlook for oil and the impact of Trump's tariffs and geopolitical tensions with Fatih Birol, the Executive Director of the International Energy Agency, who's also here in London. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the three major oil forecasting agencies have all made hefty cuts to their demand estimates for 2025. The projections by the IEA, OPEC, and the EIA follow President Trump's tariffs and the decision by an alliance of producing nations to speed up the return of barrels removed from the market 2 years ago. At the same time, geopolitical tensions escalate. The risk of energy supplies, of course, remains a major concern. And this week, the UK government and the International Energy Agency are hosting an international summit on energy security in London. Well, I'm delighted to be joined by Fatih Birol, the Executive Director of the IEA. Mr. Birol, thank you so much, as always, for joining us. So what concrete action do you hope or expect to achieve, actually, at the summit in London on energy security?
So, first of all, the first action is to bring all these governments together. And we have tomorrow 60 governments from all continents, from emerging countries, advanced economies, and the CEOs of top energy companies. At a time when the geopolitical uncertainties are going so high and the fragmentation around the world is growing, to bring everybody together around the table is, of course, a major asset for the discussions. But what I wanted to see from this meeting is there is a common understanding about the current and tomorrow's energy security risks and what we can do all together.
Can oil remain below $70 a barrel? And actually, if it does, what kind of impact would that have on the economy and oil supply and demand?
I think, again, when we talk about uncertainties, oil markets coming in on the top of it. But when I look at the numbers, our numbers, this year we expect the oil demand to increase about 700,000 barrels per day. And the production growth is significantly higher than that. In that context, if there are no other surprises, we may expect the oil prices seeing a downward pressure further.
Fatih, how's it been actually dealing with the Trump administration so far? Have there been any demands on changing the outlook or some of the models that you use to predict?
No, we work with all administrations, U.S. and other countries in a respectful way. They have their own views. Other member countries have their own views. But we work in a good spirit with our colleagues from the new administration. For example, we talk about the security summit tomorrow. We have colleagues, top officials coming from Department of Energy and Department of State coming to this meeting, as well as the other 60 countries.
Your views on OPEC Plus, was it a bit reckless to actually speed up the pace of oil supply increases when demand is shaky and we're in the middle of a trade war?
I think they may have their own thoughts and strategies, but I would say it is also one of the uncertainties how they are going to move in the next weeks and months to come in a context where we see a surplus in the oil markets, and therefore it's up to them to decide where they are going to go. But as last year, this year we also expect a rather slow oil demand growth, limited oil demand growth in the markets, mainly driven by what's happening in China.
Fatih, I mean, the other thing, of course, and there's a bit of relief on some possible deal with China at the moment. Does that change what you're expecting, again, demand to do for the price of oil? Is that a real game changer? I
think there are two reasons why we expect oil demand growth to be rather weak compared to previous years. One of them is structural, which is the China and other countries' economic growth is slower than in the past, and electric cars coming strongly. The second one is the trade wars. If there is a change in the trade wars context in a positive direction, it may well increase the global economic outlook, and we may see our oil demand maybe slightly higher than what we have now.
Will you stick with the forecast that global oil demand will stop growing before the end of the decade?
I think with the current policies, current economic outlook, current technological trends, we expect the oil demand growth will slow down considerably in the next years to come. In fact, we are seeing last year and this year, and this may well mean that the oil demand come to a certain level, and a peak level, and stay around there. It is still very high, about 100 million barrels per day, a lot of oil to supply to the markets.
I mean, the other big unknown is, of course, what happens to Iranian oil supplies, given we're hearing from the Trump administration that, you know, they want to maximize pressure, but at the same time trying to reach a deal to lift sanctions. So how do you do the outlook for that?
I mean, if I have to look at the oil markets today, there are many uncertainties. One of them is, as we just discussed, what happens with the trade wars. The other one is the economic outlook, and third one is the sanctions. Iran, Russia, Venezuela, what will happen there will also have an impact on the markets. The more oil comes to markets, the lower the price levels will be.
But for Iran, it's particularly difficult, actually, to understand what will happen because it's geopolitical.
I think it is very difficult for all of us to understand. There is a lot of discussions going on there, but we hope that there will be a good solution for everybody in this planet.
Fatih, are you worried about increasing instances of negative pricing in Europe's spot power markets? And what does it tell us about renewables?
Not for the time being. It's not a structural thing, not for the time being. And we are seeing that the renewables are growing very strongly in Europe. There are still some teething problems in terms of the availability of grids and the capacity markets, but this will be solved, and it's not a structural issue for me.
What are you most optimistic for the energy markets in the next 12 months?
I am more optimistic because a lot of new technologies are coming. The innovation technologies, the electric cars, the batteries, solar. If I give you one number, last year of all the power plants installed in the world, more than 80% were renewables and nuclear power, two carbon-free energy sources.
But we also have a lot of data centers. We're always on our phones. And so that consumes a lot of energy.
You are completely right. Completely right. We are entering an age of electricity. We have still oil, gas, but electricity will be the source of energy which will put its stamp in this century, in my view.
Fatih, thank you so much for joining us. As always, that was Fatih Birol, Executive Director of the International Energy Agency. Now, coming up, top diplomats, including Marco Rubio, decide to skip Ukraine peace talks in London today. The move raising questions about the state of negotiations. More on that next. We'll also speak to Bill Browder in a very short time. This is Bloomberg. Well, good morning and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Markets bounce back after President Trump diffuses tensions, saying he has no intention of firing the Fed chair, Jay Powell, and he plans to be very nice to China. Tesla jumps pre-market as Elon Musk pledges to refocus his attention on the automaker after disappointing first-quarter earnings, telling investors his work at Doge is mostly done. Plus, U.S. Secretary of State Marco Rubio pulls out of talks on ending the war in Ukraine, putting Donald Trump's peace efforts in doubt. Now, let's get more on that story now. The U.S. Vice President, J.D. Vance, says both Ukraine and Russia will need to give up some territory in order to strike a peace deal. It comes as the U.S. Secretary of State and European diplomats are also skipping peace talks in London today, effectively downgrading the level of the meeting. Greg Sullivan, Bloomberg's Russia and Economics Government Editor for Bloomberg, joins us now. So, Greg, thank you for being here. What can we actually expect to see out of those talks?
Well, as you said, it does appear that the talks have been downgraded now that the foreign ministers and Secretary of State will not be there. The talks were initially supposed to be a follow-up to a round of talks last week in Paris, where the U.S. essentially laid out proposals that they saw set for a ceasefire deal. Among those proposals, of course, were the U.S. recognizing Crimea, taking Ukraine's NATO bid off the table, and essentially freezing the conflict more or less along the lines of contact where it stands right now. Today was supposed to be a follow-up to that. It does seem that the U.S. is looking for a yes or no answer, given comments from the administration. As you said, we just heard from Vice President J.D. Vance, who said that they have put forward an explicit proposal and they want a yes or no. So that does appear to be what the U.S. is coming to the table to find out in these talks.
Greg, how has Ukraine responded to U.S. proposals for the ceasefire? What is President Zelensky trying to achieve, seeking a meeting with Trump at the Pope's funeral?
Well, Ukrainian President Volodymyr Zelensky is definitely in a difficult position. This is a tough spot for him. These U.S. proposals are very hard for him to swallow, and he's already said that Ukraine will not recognize Russian control of Crimea. He has said in the past that he does not want that Ukraine will not cede sovereign territory, which is obviously one of the proposals. And if the conflict is frozen at the current lines, that's a bigger sacrifice for Ukraine than Russia. Ukraine has been trying to gain back territory that Russia took first in the 2014 annexation of Crimea and then later in the 2022 full-scale invasion of Ukraine. So for him, he's now got this difficult task of balancing this, keeping the U.S. on his side, trying to instill doubt in President Trump on Vladimir Putin's intentions. It's a tough role, and clearly meeting with Trump is meant to try to thread that needle.
Greg, thanks so much. Greg Sullivan there, Bloomberg's Russia economy and government editor. Now, Sir Bill Browder has written about his experiences exposing corruption in Russia, and last year was knighted for his services to human rights. He's the best-selling author of Freezing Order, which led a campaign to persuade countries to adopt sanctions on Russian officials believed to be responsible for human rights abuses. Well, Bill Browder, co-founder and chief executive of Hermitage Captal, joins us now. Sir Bill, thank you for joining us. Do you think Russia will actually abide by any deal that Trump reaches with Putin to end the war?
Well, Putin has a long history of not abiding by any deals. He lies, he makes promises, and he doesn't keep them. And there's very specific promises he's already made in relation to Ukraine. There was a previous ceasefire deal called Minsk I, and then there was Minsk II. He broke both of those ceasefire deals. And so it's kind of hard to imagine that, first of all, that he's actually going to, that there's going to be an agreement that he's going to be happy agreeing to. And secondly, if he does agree to anything, he will violate that agreement very quickly. This is what he does. There's not a word that Vladimir Putin says that can be relied on. And so it's all really very frustrating for anybody who's a supporter of Ukraine to watch this process play out, in which Ukraine is being forced to make unbelievable concessions. Putin is being rewarded for his aggression, and there's no security guarantees for Ukraine.
So, Sir Bill, how do you see the risks and the probability of a resumption of the invasion a year or so later, if there is an end to the war?
I think that the war will carry on in all sorts of different formats, no matter what Putin agrees to this week. And from what I can tell, I don't think he's going to agree to anything this week, and I don't think Ukraine is going to agree to anything this week. It doesn't look very likely based on the demands that are being placed. But if there was an agreement, and perhaps I'll be wrong about that, you can't rely on Putin at all. Putin will continue to push on all different areas. He certainly could use some time and sanctions relief to rebuild his military. And I think maybe if he were to agree to anything, that would be the basis for his agreement. And you could be 100% sure Putin will be back at it with Ukraine, and Putin may very well be at it with other neighboring countries like Estonia, Latvia, Lithuania, Poland. And so from the Europeans' perspective, any of these surrender type proposals that are being forced on Ukraine are very negative and very risky.
But what are the choices that Ukraine has if the U.S. walks away? Do you believe that the Trump administration will walk away if they don't feel like a solution can be reached?
I believe that they pretty much have walked away from Ukraine based on everything that's happened. There has not been any new military aid agreements from the United States. I think that it's entirely plausible and possible that the U.S. does walk away, and if they do, then I think it's very likely that Ukraine will carry on fighting. They'll carry on fighting with the support of the European Union. I think there's a very high probability that at that point the European Union will confiscate Russian central bank reserves, which are currently frozen in the European Union, and use that money to continue funding Ukraine. The Ukrainians, everybody always downplays the Ukrainians from the day one. Everyone said the Ukraine was going to lose in 3 days, Russia was going to win. But Ukraine has got a very strong reason to continue fighting, which is that when Russia occupies their country, terrible things happen. The people get tortured and killed, women get raped, children get kidnapped. And so for the Ukrainians to sort of give up seems like a very unlikely possibility based on the realities on the ground.
So what's the way forward, even if Europe steps up support to the extent it can? How long in the scenario could Ukraine hold up against Russia?
Well, if the Europeans continue to support Ukraine, and if they support Ukraine in the form of lethal weapons, Ukraine at some point could end up with a military advantage, at which point they can negotiate a proper peace deal as opposed to one being forced on them. And that sort of has to be what they're looking for, is a situation where they're negotiating from strength, not negotiating because the United States is pulling out. And I think that the United States pulling out of this whole thing is pretty much already been decided. And so it's just a question of how to manage that pullout in a way that's least painful for Ukraine and for Europe.
So, Bill, what's your advice to companies and investors thinking of a return to Russia if sanctions are lifted as part of any peace deal?
Well, I was once the largest foreign investor in Russia until I was expelled. My offices were raided. My lawyer was arrested, tortured, and killed. And then I was pursued around the world with Interpol red notices by Russia. And so what I can say is, and this happened long before any invasion of Ukraine, it happened even before the invasion of Georgia. And what I can say is that Russia is a totally uninvestable country. It's a dangerous country. There's an absolute sort of no rule of law, total corruption. And anybody who ventures into Russia would be doing so at a huge, huge risk. And I would say it would probably negligent, if they're a public company, negligent going into Russia based on those risks.
But there's a belief in the Trump administration that Donald Trump could find a solution, a deal that, Vladimir Putin respects him or fears him, and so that it would be different.
Well, Donald Trump makes all sorts of very grandiose statements that don't turn out to be true, and that's certainly one here. Vladimir Putin will certainly not want to enrage Donald Trump, but at the same time, Vladimir Putin has got many of his own objectives, and those objectives have nothing to do with Donald Trump. His main objective is to stay in power until the end of his natural life. In order to do so, he needs foreign enemies, he needs wars, he needs conflict, and he also needs money. And that money will come from extorting foreign businesses, extorting Russian businesses, stealing money from people, as he's always done. And so Russia really is the most hellish country in the world when it comes to integrity in business and any type of normal activity. And anybody who's even considering going into Russia should turn in the other direction. It makes absolutely no sense.
So, Bill Browder, thank you so much for joining us today. That was the chief executive and co-founder of Hermitage Capital Management, with some pretty strong words on Russia. Now, Britain's private sector has suffered its biggest contraction in more than 2 years. That's after Donald Trump's tariffs caused orders from abroad to dry up and triggered recession fears, according to a closely watched survey. Now, S&P Global's Purchasing Managers Index tumbled to 48.2 in April, a sharp decline from the previous month. It was worse than the 50.4 reading expected by economists, and anything below the 50 threshold, of course, means it's a sign of contraction. Now, the head of the IMF has warned there's a greater chance of a global recession if uncertainty over trade drags on. Kristalina Georgieva spoke to Bloomberg at the IMF's annual spring meeting in Washington.
if we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Well, that was the managing director of the IMF, Christina Georgieva, speaking to us earlier. Now, there are also plenty more high-profile interviews from the IMF meeting in Washington this week, including with the Bundesbank president, Joachim Nagel, who will be on surveillance today at 12:30 p.m. London time. Now, a ChatGPT executive says OpenAI would be interested in buying Google's Chrome browser if a federal court orders it to be spun off. ChatGPT's head of project was called by the U.S. Justice Department to testify as part of a 3-week trial to determine what changes Alphabet Google's must make after a judge found last year that the company monopolized the search market. And the alternative medicine advocate Deepak Chopra has written dozens of books exploring health and well-being. His latest, Digital Dharma, is his 95th book. Now, it explores the role of technology, and particularly AI, in spirituality. Well, I've been speaking to him about whether he thinks artificial intelligence can actually improve human intelligence.
It expands human intelligence for sure. The big question is, does it expand spiritual intelligence? Can it help us become more self-aware? A machine that is not aware of itself, can it help you become more aware of yourself? So AI has huge implications for not only the future of well-being, the future of what we call health span and longevity, but a deeper understanding of reality. What is consciousness? What is experience? How do we engage in contemplative inquiry to access spiritual intelligence beyond, what we call intellectual intelligence or emotional intelligence, all of which, by the way, AI can help with.
What do you think of artificial general intelligence? In fact, one of the great questions that we have is, what is it exactly, and when do we know if we've hit singularity?
Well, everybody's talking about it. I don't believe that AGI will ever be conscious. Conscious means subjective experience. So it doesn't feel hunger or has sexual urges or fear death or have existential dilemmas or feel thirst or anxiety. So in that way, artificial general intelligence will not be conscious, not have subjective experience. It will simulate that, and that will happen sooner or later.
You're good friends with Sam Altman because I read you both love meditation. What do you make of tech chief executives' influence in the White House at the moment?
I think the White House has to be receptive to these great minds that we have right now in the world of technology. And the world of technology can also help solve conflicts. Right now, everywhere in the world, all we see is trying to solve conflicts through violence. So we have medieval minds as leaders in the world, and then we have modern capacities, including AI and nuclear weapons and so on. So I think it behooves any leader right now who wants peace, prosperity, sustainable planet, introduce health, well-being, to be fully versed in AI, or if they're not, they get the right team. Because there's no problem you cannot solve today if you have a shared vision, if you complement each other's strengths, if you have maximum diversity, and you create a spiritual, emotional bond in a team, then we have creative solutions. But we still don't think like that. We have metaphors of violence, the war against war, the war against poverty, the war against cancer. These are ridiculous medieval metaphors that have no place in our modern world. With the capacities that we have, we can actually, and this is a conversation I've had with Sam many times, that if we collectively use AI with a shared vision, we could help create a more peaceful, just, sustainable, healthier, and joyful world.
Well, that was the author, Deepak Chopra, speaking to us from New York. Now, coming up, Elon Musk says he'll spend more time focusing on Tesla over his White House role as the EV maker's profits plunge. That story's next, and this is Bloomberg.
When you're in emerging markets, you are in volatile environments, more so or less so. Structurally speaking, we do still have a very positive view in Mexico. On the macro side, because structurally speaking, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, it complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, you've seen it grow because structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
BBVA's Chief Financial Officer, Luisa Gomez Bravo, and Chief Executive Onur Genk speaking to Bloomberg's Kritik Gupta about the outlook for its largest market, Mexico, in the wake of Trump's tariffs. Now, they both feature on Bloomberg Chief Future Officer, which airs tonight for our U.S. viewers at 9:30 p.m. New York time and Thursday evening in Europe. Now, Elon Musk is vowing to devote more time to Tesla starting next month. He says his stint leading the so-called Department of Government Efficiency will be largely complete. Now, investors have taken Musk's decision to focus on the EV maker as a positive move. This comes after Tesla reported first quarter results that missed analyst estimates. Joining us now is Craig Trudell, Bloomberg's Global Autos editor. So, first of all, Craig, this kind of came as a surprise, but I don't know whether it's because there are tensions with people in the White House or whether he actually needs to get back to focusing on Tesla.
Yeah, I think it may be a little bit of everything here at play where, all along it was the case that, as a special government employee, he had a sort of ticking clock that he was subject to. I think he's also, acknowledging that this is not working in coming right out and beginning the call with this idea that he's going to devote more time to Tesla. But I think it's also important that we note that, last night he said as long as Trump wants him for, the length of his presidency to help out, he's going to help out, and maybe even, a day or two a week. So he's not going anywhere. He also was not, in any way sort of contrite or apologetic. He, said his critics are on the take and are paid protesters, that sort of thing. So he's not necessarily sending a signal that, I'm going to try and, make amends or rethink my actions. He was very much of the mind of, I'm in the right here.
Greg, what does he now need to do to put Tesla back on track?
I think, importantly, he needs more affordable vehicles to sell. And so that was one of the things last night that, for all of these numbers being quite weak and even weaker than expectations, their sort of assurance that these more affordable vehicles that they've said will be coming in the first half of the year are still on schedule. There was some real concern about that because of a Reuters report on Friday. They seem to bat that back, although they also didn't come right out and say that was, wrong. And so, they also acknowledged that there may be that ramp is not maybe going as quickly as they would like. So I think it's important that they do follow through on that, because this is a company that, the sales weakness is substantial on the automotive side. And another sort of key bit of news to come out of last night was the energy business, which has been extremely strong. is more susceptible to tariffs, hitting that side of the business because they have been importing battery cells from China into the U.S. for that business.
Craig, thank you so much. As always, you have a good sector to follow, especially with a lot of big personalities. Craig Trudell, they're our Global Autos editor. Now, SAP's first quarter profit actually beat analyst estimates, even as its closely watched cloud software revenue came in slightly below projections. Now, the chief executive, Christian Klein, told Bloomberg business is strong, despite worries that U.S. tariffs could trigger a global slowdown.
No pullback on spending on SAP. I mean, obviously, what they are telling me is, Christian, help me to, drive productivity. Give me more AI on asset management, on supply chain. How can I automate several tasks in my back office functions? I mean, that is, of course, what they are now more and more asking for, given, that they are under financial pressure. But what we are not seeing yet is that they are actually delaying projects or even cutting projects.
Well, Bloomberg's Charlie Wells is now here. So, Charlie, SAP's share price jumping on the back of the earnings report. So what do investors like?
So the markets are loving this. That share price is up by the most at one point this morning since 2019. And, Deutsche Bank analysts called SAP a masterclass in resilience. And what investors really seem to be liking is the fact that the business model here could withstand a lot of this tariff uncertainty because of the business that they will be booking. The contracts that they've already entered in could give them a lot of insulation in tariff uncertainty going forward. And the margins here have improved 250 basis points, or they came in 250 basis points ahead of consensus.
Yeah, that's really quite impressive. Now, did SAP give a broader read on how, it could all be affecting, how tariffs could affect tech?
Well, Francine, a framework on tech is starting to emerge as we get deeper into earnings season. And what we're seeing is firms that can get that insulation, that have this kind of booked business, those are probably going to benefit in the market. I think some tech firms that might take a little bit more of a hit, might be more dependent on headcount at some of their clients or might be more dependent on consulting. SAP, not really in that bucket.
Elsewhere in tech, Bloomberg has also learned Intel plans to cut more than 20% of its staff. What more do we know?
These are huge cuts, and a person familiar with the matter said that they could be announced this week. And this will be the first major reorganization coming from the new CEO, Lip Bhutan, who took over the company last month. And he has been trying to reorient this company as they've ceded a lot of ground to competitors. This seems like some of his strategy starting to emerge now.
I know we're knee-deep into earnings. Intel's tomorrow.
It's tomorrow, and I think that strategy is what analysts are really going to be looking out for. We've got a new CEO. Is the strategy cut? Is it something else? Is it reorient? I think that's what's going to be on the docket tomorrow in the report.
There's a lot going on. Charlie, thank you so much for bringing us up to date with some of the earnings to come and the ones that have been. Now, also don't miss our interview with the Bundesbank President, Joachim Nagel, at the IMF's spring meetings in Washington. That interview at 12:30 p.m. London time today. Now, if you look at the markets, let's give you actually a market update because there's just quite a lot going on. First of all, we're seeing the stocks definitely, breathing a sigh of relief. Stocks jumping, futures in the U.S., but also European equities jumping, bonds rising. There's a lot of relief across global markets after the Trump administration diffused some of the tensions that have rattled investors. Two main things. The president, Donald Trump, says he does not plan to fire Jay Powell, and there's a lot of growing optimism of easing U.S.-China trade tensions, and that really is boosting the mood. Now, Trump saying that he plans to be very nice to China in any talks and that tariffs will drop if the two countries can reach a deal. You can see that also playing across European markets with the DAX getting some 3%. Up next, Bloomberg Brief. This is Bloomberg.